This is Annuity Straight Talk. Since 2008, your host, Bryan Anderson, has helped clients nationwide navigate the complex market for annuities. With Bryan's assistance, hundreds of clients have achieved a profitable and secure retirement. I would know, because Bryan has answered many of my questions concerning annuities and retirement planning. So that you can benefit as well, let's get started. Here's Bryan.
Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 46. My name is Bryan Anderson, founder and creator, and I have had a heck of a good time talking to John Balmer, coming to us from Southern California. Why don't you say hello to everybody, John?
Bryan, how are you? Good to see you again, my friend. I am quarantining here in sunny Southern California. You maybe can tell the audience about my ordeal over the last 2 weeks. It's been bad timing and a little bit of isolation.
John was supposed to be here today, and he's not because he is COVID positive.
That's right. But I am feeling better.
You look great, and I will tell you, we should have flipped the recorder on about 30 minutes ago because we've been shooting bull here for a while, and boy, is it hilarious. But for this podcast, he was kind enough to join me. I needed a little bit of motivation to get this topic out, and it happened to be perfect timing for this information. So, no loss, unlimited upside potential, limited growth. I don't know, John, maybe you can tell me, is there a way to get all of the market upside with no loss?
Tough to call. If you live in fantasy land, I don't know. No, of course not. That's the hardest thing to do is to tell people and give them the reality check that if you want big upside, you've got to be ready to take big downside, and that's not what we try to do here. I know, Bryan, you and your audience know what you do. I think I've been on here a couple times. Some people know what I do. But yeah, it's all about risk management. So.
And I thought it was funny that I got an appointment request with those notes in it. And what's funny about it to me is that obviously we're talking about bond replacement, safe money, this, all the, security provided. And some people will come in and say, well, I sure like the idea of an index annuity, but I want to have all of the market with no loss potential. And I never told you this before, John, but I had a guy several years ago who he was a very wealthy guy, and he called and said, and he was trying to get me to explain the annuities, and he said, okay, well, I thought, okay, I get it. That makes sense. And he said, I kind of do that in my portfolio already. And he has a series of stop loss call provisions, puts and calls, and all that stuff, right?
Oh yeah, fun stuff.
And he said it cost him 12% of his portfolio value to put every protection in place, and he believed that he was getting all the upside, right? Anyway, so even if it is possible, it's extremely expensive. And what kind of expertise does it take to make that happen?
To have all of the upside and no downside with a 12% cost.
Yeah, is it even possible?
This is for informational purposes only, but we do have some managers and some strategies that we can hedge portfolios, and that's a big but, is that it's very cost prohibitive to do so. So unless you watched prior episodes of the Annuity Straight Talk podcast, where we kind of called this market decline, you really wouldn't know when to put on those hedges. And it's like having fire insurance or buying fire insurance when your house is already on fire. It gets really, really expensive. So you either got to think about it well in advance, or you have to think about other ways to reduce your risk, particularly when it becomes to your retirement income. Wouldn't you agree?
I no, I totally agree, and that's kind of this is you say for informational purposes only. I consider this to be for entertainment purposes only. So let's keep a lightheaded approach about this. And I'm being fairly sarcastic when I say, "Oh, no loss, unlimited upside." It is not possible. And if you don't trust an index annuity that's guaranteed to protect your money, but you're going to trust some guy that charges you 2% to spend 12% of your portfolio just to set up, puts and calls and all sorts of hedges and all sorts of things. And I mean, like, people have told me, I mean, the level of trust it would take to believe someone who says that's possible is it's impossible. Nobody has that, right? Nobody has that level of trust to say, yeah, spend all this money and do all these things. And you want to understand the put and the call and the timing and all of these different elements that would go into creating a hedged portfolio like that. I'm telling you, if you don't trust the insurance company, who the hell can you trust to ever get that done?
Yeah, absolutely. You can't. And, there's, it's crazy though that there are people out there that will listen to, whether that be a social media advisor, FinTwit, people on YouTube that have absolutely no idea what they're doing, have no regard for risk management, have no regard. There's no consequences from any regulatory bodies. Um, and you have a lot of people on what I call the Cartoon Network, CNBC, just going out there and getting people to speculate and gamble with their money. It's a bad idea.
Right. And so again, this is when, the chickens come home to roost, so to speak. So we're talking about this today. My appointment request came up last Thursday or Friday. I thought, oh, I'm going to do a little blurb on that and I'll talk about it. And then I, turned into to today before I could get it done. And on my first phone call this morning, I pulled up Bloomberg, and sure enough, the S&P was down 3.5%. And it's like, ouch. But I've immediately thought of John. That's why I texted you this morning, right? And said, hey, do you want to do a podcast today? And the reason I had you on here is because I recognize something unique in you. And I've had lots and lots of people tell me they appreciate what you're saying. And so, any opportunity we can have to kind of go over again your analytics, get everybody to understand it. I mean, this is, I can say, probably the best time in my career because rates are going through the roof. And you look at a traditional portfolio of stocks and bonds, and it's a double whammy because rates are going up, which means bonds are getting smashed and the market's dropping. So you've got losses on both sides of it. Anybody who bought an index annuity from me in the last 3 or 4 or 5 years, now is the time when that's of true value to you. I had someone I had a annual review with 3 days ago, and his index annuity, in that contract, he replaced the bonds in his portfolio with an index annuity, and he made about 1.3%, which I consider an extremely huge win, considering that if he had not done anything, then he would have got clobbered on that and lost 15% on his bonds, probably in value, right?
Yeah, absolutely.
So you look at the double man. I mean, years past, I did bonds plus. Index annuities are bonds plus liquidity, bonds plus yield, bonds free of interest rate risk. And right now is a time when you have to be really careful about watching what your portfolio does, right?
I would definitely agree. Using that strategy of using an indexed annuity or a combination of fixed insurance products to replace fixed income in a rising rate environment was a prudent move. I mean, if you take a look at the Barclays Aggregate Bond Index, I think it's down 12% year to date or 15% year to date. Historically, bonds aren't supposed to lose money. That's why I have a 60-40 portfolio. I'll tell you, it's not working anymore. You have to find something that's going to work. And if you're not working with an advisor who's going to be creative for you, you're going to end up losing a lot of money.
That is, well, and
That's just a lot of conviction. I mean, I don't know what else to say.
okay, we're done. We're signing. Yeah, we're signing off now. We're done. No, we're not done. But no, but you're right. As complicated as everybody wants to make it, John, like it, you know, everybody wants to dig into the weeds and get technical about certain aspects of it, but the principles are pretty simple and it's not that hard to understand. I mean, what do you in retirement, what do you want to deal with?
I want safety and security and an income that I can't outlive. That's what I want. I don't necessarily.
Well, and the reason I ask you honestly is because you don't necessarily I deal strictly with retirees or pre-retirees, and you deal with different people. Of course, your own portfolio is another example, and we're going to cover that. We're going to talk about a couple of his good clients who do everything he says. When he comes up here, we're going to do that one today, and this is a different one, right? So, but when you get over your COVID, you seem fine to me. But when you get over COVID, you're coming to Montana 2 weeks from today or yesterday.
2 weeks from yesterday. So coming up on the 26th, spend some time in the beautiful outdoors, get a podcast or two done.
Flying into Kalispell, Montana. Oh yeah, good times. Grilled burgers, smoked burgers. Oh no, I saved some steaks for you. So
Thank you.
okay, so what do you see as far as like again the topic no loss unlimited upside not possible. If you want to reduce risk, then you've got to concede to lower yield in some ways, but then again, the lack of volatility in those lower yielding products can produce a very similar result in the long run. And retirement is a long run, but again, this hit me this morning. It was very last minute, but you had, you want to talk about what's going in the markets right now, John?
Yeah, it's been a very difficult and it's been a tough tape, as they would say. There is a ton of volatility. I'm not sure what the VIX got up to today, probably low 30s, and was able to maintain that. We had several different gap downs over the last few days. So, they're really kind of letting you take 2 steps up and then they're going to slam you back 5 steps. Um, if we just kind of look at it, we were just talking about the Barclays Aggregate bond index. And if we kind of look at that, I mean, what does that show us? If we go year to date,
Yeah, share your screen. Share your screen. Let's see it.
what do we say? Bonds aren't supposed to lose money. So here we are today. Bonds are down in aggregate 12%, 12.6%. Let me share my screen for you.
Yeah, do that.
This here's the obviously, again, informational purposes only. Consult your advisor or talk to Bryan. You can reach me through Bryan if you'd like.
Hold on a second, real before you start explaining that, John. I'm the gatekeeper. You don't just get to call John Balmer. I worked for 20 years to establish myself as an expert in my field, and only then did I get an opportunity to meet John. We've become friends over the past year or so, and yeah, you're not allowed to bug him. You call me if you want to talk to him.
Thank you.
And I will personally determine whether it is appropriate that he spend his time helping you and answering your questions. But for here, be grateful that he has been a willing member of willing co-host or guest on the podcast. So go ahead, John.
Thank you, Bryan. I love your podcast. It's been great. I just, I'll show the audience here. I mean, this is basically the Barclays Aggregate Bond Index year to date. I'm going to get rid of the volume here. You can see we are in a defined downtrend versus an uptrend that we had for the last 30 years. So remember, when rates go down, bond prices go up, and the inverse is true as well. So when rates start to go up, the price of the principal value of your bond falls, and it can fall precipitously. So we've seen that here. This is the iShares U.S. Core Aggregate Bond Index, formerly known as the Lehman Brothers Aggregate Bond Index, or I think they call it the Barclays Ag now, since 2008.
What's the starting value, ending value? What are we down?
So
The numbers are kind of small.
yeah, the numbers are small. We started the year at $113 per share. Ended the day today at 99.60. If I just take that as a measured move, I'm going to calculate what that drawdown is. That drawdown is, roughly 12.4% year to date. So that's a year to date number. Remember, bonds are supposed to be the bellwethers in your portfolio. Um, they're supposed to buffer any volatility. The problem is that bonds just aren't working right now. So there's a lot of different types of bonds out there. There's U.S. Treasuries, there's corporate bonds, there's floating rate bonds, there's municipal bonds. Um, but those that are interest rate sensitive, and the Barclays Aggregate Bond Index is just that, an aggregate of all types of bonds. You can see that being down 12% in your bond portfolio is just probably, if you're a conservative investor, probably not a good place to be. So, what are the alternatives? Brian and I have really been talking about for the last going on 6 months index annuities as an alternative to fixed income or as an alternative to bonds. Cash is also a fairly good place to be right now. People can make the argument about inflation and how it's 8% and how cash would be losing money. And we're not talking about storing your cash for the next 30 years, in a money market fund. We're talking about preserving your capital and then being opportunistic when the time presents itself to purchase things that have been really, really beat up. So those are bonds. I can go into the stock market, the S&P 500. I can go into the Nasdaq. We can go into whatever you'd like to go into, Brian.
Yeah. Well, what do you want to do? I mean, what do you want people to see? It's interesting because uh, a number of people have mentioned, oh well, John said S&P 3500, and so I'm waiting for that. Like, I mean, people are listening to you, and I'm not going to ask you. I know you maybe change your target a little bit, but um, I'm not going to ask you to put yourself out there like that. You do what you want. As we record this, it's live, and John can say whatever he wants to say. It's nothing is scripted here. So again, like I talked about Safe Money Radio, where they're reading the sheet. Do. No, no. We're a couple of free men recording a podcast and saying whatever the heck we want to say.
That's right. So let's just take a look at the S&P 500 as a proxy. I use the State Street SPY ticker symbol SPY. This is, let's just take a look at the long-term chart here, going all the way back to 2008. So you're probably way back here. And this kind of gives you the long-term focus. So if you are a long-term investor, you can ride out a lot of these bumps. You get here, here's the March of 2020, pretty precipitous drop. 7 trillion of liquidity goes into the market, and you get to the point where we were in November, December of this year. Um, Brian, you and I kind of had a podcast right around Thanksgiving about talking about when is the market going to crash.
Yes, we did. And anybody who's been listening to it for a while means that we've been talking about this volatility because, I mean, a year back, I said, people say, what's going to happen in the market? And I think uh, from a pretty rigid perspective, people will think, oh, the market's going to drop and then it's going to come back. And I said, no, I think there's going to be a whole lot of volatility. We started talking about it, and you kind of agreed with me, but also offered the technical backing for that. So go ahead and remind everybody.
Yeah, absolutely. So, we had really a V-shaped recovery, and you can kind of see that here. I mean, you and I talk about it quite often. You have a V shape, and you have another V shape here, and boom, there you go. There's your V-shaped recovery. Okay, it's all good. Um, but what happens when you have record high inflation? I don't know what was the print last week on Thursday, and that's what kind of really got this going was you know the price of diesel fuel. I know, Brian, you drive a diesel truck. Um, I drive an unleaded gas vehicle. I don't have an electric vehicle. Even if I did, my power's gone up by almost 25% because what people don't know is that most power generation in the US is, comes from power plants that are fired by natural gas and coal. So much more or less coal, but a lot of natural gas.
I think the people that listen to this podcast know that.
Yeah,
I'm giving props to our subscribers and our audience, and they're smarter than average. So
absolutely.
I filled up my tank yesterday. I paid 5.86 a gallon for diesel, and it was $129
Wow.
to fill up my truck. And I thought, ouch. And I hurt for people on fixed income. I make a good living. I can afford to do that, but I'm not saying I like to, because that was about twice what it was a year ago. And it's going to make a difference for people. Difference for me is I drive around a lot. I cover miles. I'm in Montana, so anything I have to do is at least 10, 15, 20 miles away. I'm driving 50, 70, 80 miles on a regular basis. So anyway, that's a total tangent, but
659 is what I paid for 87 yesterday. 659. I'll have to find the picture, but during the pandemic, I think I snapshotted $2.39 for the same gallon of gas. So our gas is, tripled. It's almost, I've seen as high as $9 here in California, but that's beside the point. That's what's driving a lot of the inflation that we have. If we can get rid of, or if we can lower energy prices, that will help curb a lot of things. And no, I don't think it's all Putin's fault. Um, that's another story. But let's go into this. We had a really terrible inflation print, 8.5 or 9% on Thursday, that caused the market to sell off pretty significantly here. And I'm just going to kind of zoom in here. Maybe not so much there. You can see here, Brian, that we had this whole area. See if I can just draw this right here. This nice circle. That was Thursday. We had what's called a gap down Friday, so that continued. And my favorite stock, DocuSign, was down 24% for maybe the third or fourth time this year because of missing earnings.
ramen noodles for you.
Ramen noodles for me for sure. And then today, that just momentum continued of poor inflation numbers, poor economic numbers, and just an overall sense of desperation. We had another gap down in the market today, and it was gap and go, gap and go, gap and go. This is some pretty significant moves. You ended last Thursday, at $411 per share on the SPY. You finished today at 375. That's a pretty significant drop. If I just get rid of these drawings, I'm going to give you a measured move on this particular fun stuff. I'm going to give you a price range. So from Thursday to the close of business today, the market is down almost 10% in 3 days.
That's insane.
So where do we go from here? I like to use what's called a measured move. And certainly we have hit, not coincidentally, a little bit of support right here. So this support line here, there's probably no coincidence that it can go all the way back to right here. So you can see that right here. You have some pretty strong support here. The problem is that the economy's not doing really well. It's getting worse. People are starting to feel it, particularly with the price of gas. All the trips people are taking, they paid 4 months ago when the price of jet fuel hadn't tripled, things like that. I think that we see some continued downside, and I think when we talked, maybe in January, what was my price target on the S&P 500 was maybe 3,300. I kind of revised that to 35, and I was being very optimistic. Maybe raised it to 3850. Well, where are we right now? We're at 375, which is 3750 on the S&P 500. It's I think I have a new price target here, and I'm just going to take it down, and I'm going to move it to the pre-pandemic high, and I think I'm going to give you that new price target of 338 on the SPY or 3380. I'm going to move it back to my original price target, probably within the next 6 to 9 months. So that is if I take a look at it, and we could give it another measured move here. That is a move of another 10% in the market, another 9.8% in the market. And it's no coincidence here that you have this move, and if I just copy this and I paste it and move it down here from top to bottom and just stack these, it's no coincidence that these are virtually the same move. So another 10% down move in the market. That would put us at what? Down 30% on the S&P 500 for the year. Probably much more so on the NASDAQ. And that's just getting back to let me reset this, the pre-pandemic high. So an entire 2 years.
Yeah. I want you to go back to that at some point, but go ahead and finish.
Yeah, an entire 2 years worth of gains, and pretty significant ones. I mean, just think if you were buying above, August of 2020, you're basically giving everything back. I mean, we have some certain stocks. I talked to one of my friends who's a very talented former portfolio manager. We talk about some of the stocks that are, if you bought Disney 5 or 6 years ago, you've lost money. 5 or 6 years. That's just destruction of capital. It's terrible.
And that's not so. If you look back at like September, October last year, if you just move your cursor over there, like that's where. I mean, I should have pulled it up, and yeah, go back there, and like that's where we had the first podcast, where like market crash is coming, and again, just reading charts so people know what to expect as you're trying to make plans. It's not to freak anybody out. Again, for entertainment purposes only, but we look at what's happening right now, and I want to know that we've kind of been here every step of the way. This is our fourth market-based podcast, is it not?
Yeah,
Where
absolutely.
we've kind of talked about it, and I talked to a couple people today because rates are up, and people are locking into MIGAs and all that stuff, and anybody right now, I'm saying, just hold off and wait till the end of the week and just see what happens, right? Because who knows what's going to be out there. And The market and interest rates are going in two different directions, which is not something that happens very often. Um, I don't disagree with you. It could go even lower, to be honest with you. I mean, the 2 and 10 was about to invert. 2 year, 10-year Treasury.
Yeah, the move on the 2 year has been just astronomical in the last 5 to 6 days. What I want to kind of point out to people who, when we do end up getting a rally, and maybe we get a rally for the rest of the week, because we've kind of hit a couple key support levels. Remember during the 2000 to 2002 bear market, we had almost 10 or 15 counter trend rallies of 10% or more. So to have moves like this here, up a rally, bear market rally. You had one just last week, bear market rally. It was like 7% in a week. And bam, you get slammed back down. Probably have another rally, slam back down. So this does not go down in a straight line, although I wish it would so we could get it over with. This could play out, way out into, middle of next year, depending upon when the recession comes. And I don't know what they keep saying on the Cartoon Network, but I do believe we will have a recession. People are going to start to lose their jobs. Um, it's inevitable. It's inevitable. You're already seeing a lot of the tech sector, which is a huge part of our economy, starting to slow down. And you're starting to see layoffs already or hiring freezes already.
The sentiment on Bloomberg today, I was watching it before we flipped this on. Very different sentiment. It was more of a frantic idea of like looking at all the factors and all the things that are going wrong. And again, cooler heads prevailed. So we're sitting here, just kind of methodically chipping along, thinking about how do you make good decisions, uh, based on the information available in the current markets and all that. So, right now is a really good time to get into fixed products for retirement purposes only. If you're 30 years old and throwing money into the market, you're probably fine to stick it out and you'll do great over the long run. But anybody who wants to preserve capital, now is the time you should pay attention, in my opinion.
Yeah, I'd agree, Brian. We have a lot of different alternatives that we can offer people. First and foremost, if you're looking to protect your retirement income or your nest egg, and you don't want to have volatility like this, 20% or down 4.65% on the day, which is a lot of money. Um, it's I think people should start giving you a call and talking to you about some of the risk management techniques that you can offer, or maybe some of the things that I offer that are alternatives to volatility in the open market.
Yep, exactly. Um, and plenty of upside there as well. No such thing as no loss unlimited upside. But I think we drove the point home, and today was the day to do it. So you've got, and again, this is episode 46. This one's time sensitive. If you're watching this a year from now, we don't mean the same thing. But again, that's why we share the charts and show you time sensitive information. Things are going to be different in a couple of weeks. Maybe John will actually be here. We're going to do something else and maybe talk about one of the portfolios that he manages. Um, anyway, any closing thoughts, John?
Yeah, just let's market now. Some levels to watch. We've already but have 338 is kind of maybe my next target. Ultimately, before if this washes out, but if things get really really bad, remember we saw $1 trillion of retail money come into the market last year. We've only seen 40 billion of it outflow. So retail investors have yet to start to panic sell. Not to say that they will or they will not, but I'm just going to mark a line here on my chart. You and I can talk about it later. That's 292 on the S&P 500. That's another level. And ultimately, I'm going to mark right here, right around 228 as potential levels of interest that the markets could get down to over the next year and a half. So This is going to be a long. You're going to have to play the long game. Be patient. A lot of people talk to me all the time like, hey, I'm sitting on a 25% loss. Why would I sell now and lock in that loss? Well, it could go down another 50%.
Yeah, you just never know. So eliminate that for at least a part of your portfolio if you can.
Yeah, first and foremost, risk management is something that you and I talk about all the time. So,
Mm-hmm. Yeah. No, thank you. I appreciate you explaining it to everybody. And anybody who wants to talk to John, you got to go through me. Um, this has been episode 46, No Loss, Unlimited Upside. It's a fairy tale. We're not talking in fairy tales. We're talking about real numbers and how you can make a real difference in your retirement plan. Brian Anderson, if you want to schedule a call with me or with John, you can schedule on the website, the top right corner, schedule a call. Call 800-438-5121 to get a hold of me. Rings right here on my cell phone. And if I like you, I'll give you my cell phone. You can even text me. So anyway, John, thank you so much for doing it. I don't want to scare anybody by any means because, again, like we said the last time we talked about this, if you're adequately prepared, none of this stuff should bother you. And that's what we do. We set up for the top side, we protect the downside, and that's why we make a good team. So, John, thank you so much.
Brian, thanks for having me again. Didn't mean to hijack most of the episode, but appreciate you having me on again. Look forward to seeing you in about 2 weeks.
You got it. I did my fair share of talking, so it doesn't matter. I don't feel bad if you want to steal the show. That's who everybody came to see anyhow. So anyway, Annuity Straight Talk episode 46. We're off for now. Thank you so much for joining us and have a great day. Okay, bye.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.